So let's take a look here. Should you get an IUL or should you get an FIA? Let's jump into this. Here we have an IUL. An IUL typically is going to be active contributions. So if you are somebody who wants to save money on a consistent, regular basis, like every single month, every quarter, every other week, whenever you get paid, if you are somebody who wants to constantly save money, then that is one of the first parameters for an IUL, because you can't just really pay for it once. There are some instances where you can, but it's not really how they're set up, because there's always going to be a cost of insurance with the policy. So you want to be actively putting money in on a consistent basis for an extended period of time. So typically people will set these up in lieu of or along with 401ks and IRAs, right? So they're setting it up more of a long-term contribution plan. So active contributions, not just a one single premium. Next thing we want to look at is your age. Typically under 50 years of age is kind of like the threshold on, hey, does this still make sense? Depending on what your goals are. We do have people that are 60, 65 years old that have just set these up, but they're putting a lot of money in and they're not using it for retirement planning. So a lot of clients that are actively, or just a lot of people on social media, they see these IULs. Well, if you're under the age of 50, at least you have like 15 years typically for retirement planning. But the longer you have for retirement planning, because a lot of people are wanting to use this as a supplemental retirement income for like tax-free retirement, or they want to use it to be their own bank. But about under 50 years of age, that's when we would really lean more towards the IUL, because it's still favorable for you. Once you get over the age of 50, it really comes down to like, hey, what are you contributing? How much? What is your purpose of the funds and stuff like that? So typically, if you're under 50, IUL is kind of going to be the first point direction we go. Next thing is going to be if you want liquidity, right? So you want access to the funds. So if you're 20 years old, most of the time you're going to need access or want access to your money throughout your life. Whereas like an IRA or a qualified retirement plan can't touch it till 59 and a half, okay? So if you want access to your funds, everybody wants access to their money, but if you're going to really need it, and 20-year-olds, 30-year-olds, and 40-year-olds, there's a good chance they're going to need that money before 60, or they're going to want to use it to leverage it to go purchase other assets throughout their life. So usually if you want liquidity or need liquidity, same for business owners. Business owners will set these up and then pull the money out to leverage in their business, but they'll also put the money back in. So it's a constant leveraging of money. So if you need liquidity or want liquidity throughout your life, the IUL is going to be the direction to go. The next thing is going to be your own bank. That falls in line with liquidity. Again, business owners, they'll make $100,000 a year, they'll put it into the IUL, and then they'll pull it out, leverage it, scale their business, buy ads, whatever it is they're doing. And then they take revenue from the company and profits, and then they put it back into the IUL. So the be your own bank concept is having a place where money is protected with a 0% floor, just like your current bank account, but participate in the market gains. So you get like bond-like returns, right? So they're making money, but they have access to leverage that money and pull it out in the form of a loan, tax-free, go deploy it elsewhere, and then put it back in once they reap the rewards from whatever assets or whatever they purchase. So having to be your own bank to where you can leverage it, financial stuff, and be your own bank concept, that comes inside of the IUL. That's not in the FIA. So having that kind of liquidity will be over here. The next thing that kind of still falls in line is if you're planning like long-term play, would be like a tax-free retirement, like a supplemental retirement income stream. With the properly structured IUL and a properly funded IUL, you can leverage the tax codes in your favor to create a tax-free income stream from this in retirement, because loans are non-taxable events and it accumulates on the tax-deferred basis. So eventually, give it time, if you have a long enough time, 20, 25, 30, 35 years of compounding, well then at that point in time, as long as you're responsible, you could take distributions tax-free in the form of loans. So not technically a distribution, but it's a loan, and it's tax-free, and then you keep taking those out however you see fit until you pass away. Then it's paid out tax-free from the death benefit in your account. So it gives you the ability to have a tax-free retirement, which you could also have in an FIA if it is a Roth. But as far as overfunding, because Roths have limitations, you could do that over here in the IUL. Another benefit is privatization and protection of money. So this is huge for business owners. A lot of business owners will set up insurance plans, not typically to get the returns, not really trying to retirement plan. They're looking to privatize and protect their money, because money in a life insurance policy is protected from judgments, liens, and lawsuits and stuff like that. So they can privatize because it's life insurance on somebody's head. And then one of the next things that we'll look at is just benefits of life insurance. Are you married? Do you have children? Can somebody benefit? Because there is associated cost of life insurance in an IUL because it is an indexed universal life insurance policy. And under very specific tax codes, ordinary people like you and I can store money in a life insurance contract. It accumulates growth on a tax deferred basis that we get access tax free. And then when we pass away, it blossoms and pays out tax free to our beneficiaries. But that's because it has life insurance. And so in order to do that, there's a minimum amount of life insurance that's required by law based off of the maximum amount of money you want to save. So if you're saving $12,000 per year, you're probably paying like $1,200 or $1,500 per year in associated insurance costs and fees. So it does have a cost basis to it. And so, but you have an immediate death benefit. You probably got like $250,000 or $200,000 in death benefit. So God forbid you passed away tomorrow, somebody's going to receive money that was supplemental to what you put in or additional to what you put in. So that's another added benefit of it. So especially if you could be 40 years old and if you're married and you don't have life insurance and you have children, well, the cost of life insurance doesn't really matter. And it will eventually, the cost becomes subjective because the interest accrued in your account will pay for it. But it does come with a negative arbitrage at first, and then it becomes positive in the future. Next, let's look at the FIA. FIA stands for fixed indexed annuities, not to be confused with a variable annuity or those ugly annuities that have a ton of fees and stuff like that. This does not have that. This is a different structure. This is not the old school annuities that you heard of when your parents and everything were like growing up. These are newer and they have evolved since then. So fixed indexed annuities, they're more like a private pension. This is great for people that are rolling funds from an old 401k, IRA, TSP, another type of qualified plan, a private account. You could roll your funds as long as it's not tied to your current employer. You can roll those funds into an FIA at no cost to you and no penalties, okay? Because again, if you're 40 and you have 100 grand sitting in an old 401k, well, you can't touch it until you're 59 and a half. Otherwise, you're penalized to 10% early withdrawal penalty. And so in order to take back control of that, so that way you have a little bit better position in the market and stuff, you can take it, roll it into an FIA at no cost and no penalties to you, and then protect it from the market losses, right? And then you have a private account. So it's like a private IRA at that point in time. So it's great for that because, again, there's no cost and you get to participate in gains. Single contributions. This is also great for single contributions. You can set these up to where it's like, hey, if you got 200 grand just sitting in your bank account, that's not doing you any justice, but you don't want to go invest in the stock market because you're not a day trader, right? Well, then in that case, but you don't want to keep it in the savings account because you're getting like negative returns due to the fact that inflation is eroding the actual utilization of the funds in your savings account. Well, you don't want to participate in that either because that's just silly. Well, then you can roll it into an FIA and then you get market-like returns, right? So it's great for single contributions for anybody who's just sitting on a fat wad of cash for no apparent reason. Market-like returns, so it's great for people that want the market-like returns without the risk to market losses because you have a 0% floor when structured in the right product and in the right company. They have zero risk to market losses. So if you roll over 200 grand, I could guarantee that it won't go below that because the floor is 0%. That's a fact, okay? And so you get the potential to participate in the gains without the risk to the market losses. So you could get 10, 15, 20% per year in market gains because you're linked to indexes. And these insurance companies usually give you higher participations depending on the indexes and the allocations and the strategies and the contractual periods and stuff like that. But you get returns on your money that are favorable, far more favorable than an IUL, just due to the sheer nature of the structure and the longevity of the contract because it does have a contractual time constraint to it, typically 10 or 15 years. And so what happens over there is you're able to get higher returns, right? And you don't have the associated cost of insurance. So it's more beneficial for people that don't want to have a direct associated cost, but they could keep it locked up for a little bit of time. Can't get approved for an IUL. That's a big one, okay? So a lot of clients, because there will be 30-year-olds that unfortunately have health circumstances or health situations that don't get them approved for an IUL. An IUL is a life insurance policy. So if you cannot get approved for life insurance or you have been denied an IUL, then you still want to plan for retirement. You still want to save your money. You still want to do smart financial things. So setting up an FIA because you don't want to risk it to losses, right? You don't have losses over here, and that's why some people like it as well. It's 0% floor, bond-like alternative returns, 6, 7, 8%. Over here, a little bit better. You don't have the associated insurance costs, so you don't get that added benefit of insurance. But if you can't get approved for an IUL, you may opt for a flexible FIA, okay? The next thing would be somebody who wants to protect and preserve their wealth. So the same thing. You have a couple hundred grand, or let's just say you're 60 years old. If you're 60 years old and you've amassed $1 million in your 401k or IRA, well, you don't want to you don't want to leave it in the 401k and keep it exposed to the market, because if the market dips 20%, what do you have? You have 800,000, which is unfortunate, because especially if you retire and you take money out. So imagine if you have $1 million and you take out 100 grand. So you have 900 grand because you need 100 grand to live off of. Now you have $900,000, but then the market just tanks, just like it did yesterday. And that's just, but it wasn't horrible. It was a few percent, like 3, 4, 5%. But if it tanks 20% in over the course of a year, you go from 900 grand, you lose $180,000. So you now have 720. But now you need to take 100 grand out because you're still using it to live off. Now you have $620,000 and it's only been 1 year of your life. So what happens is at age 70 or 75, you go back to work. Well, you don't want that to happen. So somebody who wants to protect the money that they have built up at age 60, 65, 70, whatever you have generated throughout your life and you don't want to lose it, you would roll it into a FIA. That way you have a 0% floor, but you still get the market returns. So if you start making 8, 9, 10% per year in your FIA, you could take 8, 9, or 10% out to live off of. So that way you preserve your principal and that way you're living off of your interest. So it's great for that. Next would be somebody who wants flexibility in contributions, okay? Because remember, you could do a single contribution, but you could also set them up to be flexible in contributions. And it has more flexibility. The IUL has some flexibility because there's a minimum that you have to pay. There's a maximum that you can pay. But the problem with that is if you start to become flexible from the maximum in the IUL and you come closer to the minimum, what's happening is you're not saving money for yourself, you're just buying life insurance. So the goal with an IUL is to not really be flexible on your contribution completely within it. If your limit's 12 grand a year, you want to get as close to that 12 grand. Because if you start falling towards 2, 3, 4, or 5 grand, you're not performing as well as you can on your actual cash, and you're just buying life insurance or putting more towards your life insurance. So over here in an FIA, a lot of times the minimum is only like $100 per month. And eventually that minimum gets negated once you have a certain value in your account, like probably $5,000, right? Some accounts specifically, if you have $5,000 in your account, you satisfied all limitations as far as minimums, and you don't even have to make monthly contributions. So your minimums are either $100 sometimes or $5,000. Again, that's dependent on the product, the design, and stuff like that. So don't hold me to that on every one, but some of the ones we set up, those are the minimums. Don't need it until age 59 and a half. This is the biggest issue, okay? If you don't need your money until age 59 and a half, FI is good for you because it's an IRA. 59 and a half rule is just the rule. It's if you touch your money prior to 59 and a half with your 401k, your IRA, your retirement accounts, you are penalized 10%. Very few select accounts in this world allow for your 401k or IRA to be touched at like 55. Most of the time that rule is 59 and a half. So if you don't need it till 59 and a half, then the FIA is good for you, right? So that's why like a 20-year-old or a 30-year-old, we're probably not doing the FIA unless it's a rollover, okay? Or if they can't get approved for an IUL. Those are the only times when we set up a flexible FIA, right? Is if it can't get approved. And then if it's a rollover, it would be a single contribution, right? Otherwise, most of our younger clients will go the IUL route because they want the liquidity and the access to cash. And then when we get over here, it's 59 and a half. There's another limitation that comes with an FIA. It's the contractual timeline. There's a surrender period. So if you put in $100,000 in cash or something, you can't touch your money till 59 and a half with the early withdrawal penalty. The government rules, that's their government's thing. That's not even the contract of the FIA. The FIA has a contractual timeline. Typically, it's about 10 years, just on average, I'm going to round it down. Sometimes they could be 15, they could be 7. Most of the time, though, you'll see a 10-year contract, which means if you give the company $100,000, you're getting a contract stating that you're not going to touch it for the next 10 years, unless there's liquidity in it, right? If you're 60, we could get you 10% liquidity. So there's a 10%, but like as far as 100% liquidity in case of an emergency, you don't have it. And if you do touch it, you are penalized in that contract period. You have surrender fees if you touch it within that 10-year period. So typically this is for people that don't need the money till 59 and a half. And so between those two, that's kind of just again, this isn't all of it. This is just like a baseline premises of like, hey, should I do an IUL? Should I do an FIA? What's the difference? Again, biggest thing that we like to see here, active contributions. If you're paying monthly and you're under the age of 50, we're usually going to consider the IUL first. If you have rollover funds, you cannot roll a qualified plan into an IUL. I get the question all of the time. You can't do that. So what do? Is we roll it into a 401k. Could you cash out your 401k or your old account? Yes, but you'll pay taxes and you will be penalized. So do we recommend losing 40% of your money? No, when you can just put it into an FIA and not worry about it and set up an IUL for active contributions. That is most of the time the direction we would go in. So if you have any questions, if you've been considering an IUL, if you have an old 401k, if you're sitting on cash, mattress money, reach out, jump to the profile, schedule a consultation. I'll personally hop on the call and just see what makes sense, look at some numbers and see if any of this would be good to add to your retirement portfolio.